now is the time for the banks' chance to use their hard-won resilience to preserve the financial system and support their customers and communities. The banking industry can unequivocally act as a primary source of stability. Banks guard savings and investments, provide credit and financing, deliver safe and secure payments and transaction service, and offer trusted advice. They are not simply commercial enterprise, but playing a vital role in the function of the economy. McKinsey have developed 9 potential macroeconomic scenarios for the economy over the next 5 years, reflecting a range of various containment, public health, and economic policy response. Recover when it comes will vary in speed and intensity across industries and regions, says Roland Berger. Now, one size does not fit all. But in this environment, banks will need to provide differentiated client relationships and to reduce their cost structures dramatically. The flexibility to address new realities will matter a lot. The potential for automation will shift the role that banks need to fill. Systems, more flexibility. Review their model strategies, short-term and long-term actions. Implement a model risk management framework that links the models to the bank risk appetite and management, rather than acting as a control function. Today with us, we have HP. Hi, HP. Good afternoon.
Good afternoon, Diogo. Thank you for having me.
Thank you, us. So HP is a senior guy in the industry banking. He have worked in the 2 top 10 banks of United States. And also it is industry vertical. It was the industry vertical for data robots. He worked with more than 100 banks and fintechs across US and also across some countries here in Europe. I have the pleasure to meet HP from here an half ago. And you will join us today and share with us some information very, very important in this time.
Let me start with a few quotes that I think will sum it up well. Eric Brynjolfsson and Andrew McAfee from MIT wrote in the Harvard Business Review that AI, and in particular machine learning, are the most important general purpose is the most important general purpose technology of our era. Jeff Bezos said we are at the beginning of a golden age of AI, and that we've only scratched the surface of what's possible. And McKinsey, in their recent research, observed that early movers appear to be racking up performance gains and then turning those performance gains into a second stage of investments in AI. And the leaders are beginning to pull away from their competition. And McKinsey concluded that waiting carries risks. So in answer to your question, why now? My answer would be, if you haven't started, you need to get started. And if you have started, you need to accelerate. I think there is a competitive risk if you wait and see and let others get out ahead of you, because the research indicates that it may be very difficult or even impossible to catch up with the leaders in AI.
Okay, and sometimes we consulting like to say back to the basics. For people who may not be familiar with these terms, what are AI? What is machine learning? How are they different?
Great question. So very, very simple definition here. Machine learning is a series of techniques, algorithms that are used to build predictive models. These models learn from historical examples in order to make predictions on new data. It is this self-learning that makes machine learning such a breakthrough technology. Historically, you had to spend enormous amounts of time and efforts to build the rules into a system to make it do what you wanted it to do. Now, with machine learning, the systems can essentially train themselves. They can learn from examples that you provide how to predict events or outcomes. AI is a system that is able to do something that ordinarily would require human intelligence. And it combines data with the predictions of a model created with machine learning and integrated into your business process in order to take action. So if AI is the result, machine learning is the way that you get there. Machine learning creates the models that are the building blocks for AI. There are a few different types of machine learning, and I'll just touch on them very, very quickly. The most common type is supervised learning. Supervised learning works very well when you have a lot of examples to learn from. So you may know from your history which loans defaulted and which ones did not, which ones became delinquent, which ones did not. You may know, for example, in financial crime, which suspicious activity alerts turned out to be serious issues and which ones were false positives. These are all great examples for training a model. And when you have those examples to learn from, supervised learning techniques work very well. There are times when outcomes are not known or cannot be known. For example, if you're looking for suspicious activity that you've never seen before, patterns of activity that may indicate fraud or may indicate money laundering, for example, but because they're new types of fraud that you've never seen and you can't train a model on, you need a different way to detect those types of activities. And unsupervised learning works well when outcomes are not known or cannot be known. Two typical ways that I've seen unsupervised learning used are in anomaly detection, looking for things that are very, very unusual, or in clustering, where you have, for example, clients behaving in different ways, and you want to group those clients according to their behavior, but you don't know what those groupings are going into it. There's a third technique which combines both of the supervised and unsupervised learning in series, where you use one and then feed the results into the second. And that works really, really well in financial crime. And I've also seen it well in cases where you have a rules-based system that you've put tremendous investment in. You can use unsupervised and supervised learning together to make that rules-based system even better.
Concerning your huge experience of helping banks and fintechs around the world to get really value in their data, where are the companies struggle with AI and machine learning?
Yeah, really good question. So this is sort of a shocking result of the research that 96% of companies experience problems with model development. And a lot of these problems are typically trying to extract and synthesize the data. They may have fragmented data that's on multiple platforms. They may not have a holistic data architecture. It may be difficult to access the data and prepare it so that it is fit for purpose. So all of those challenges around getting the data and preparing the data can be significant. But the other big issue is that there are hundreds and hundreds of modeling techniques, and it is a practical impossibility to know which modeling technique will work the best beforehand. So a lot of time is spent trying different models and looking for a good solution, and then tuning each model to try to get better accuracy. And these can be very, very time-consuming and arduous tasks. Although there are new technologies emerging that will make this both of these problems significantly easier, and we can talk about that later. The other problem that many companies cite is getting models into production. In other words, getting them from the lab into the field. And some of the problems that I've seen is that the models are developed in such a way that they don't fit neatly into the production technology infrastructure. And in some cases, they have to be rewritten entirely. There are also, there's significant, especially in banking, model validation and model risk management requirements. Preparing all of this documentation and doing all the tests and validating the models and checking for bias and making sure that you're not using any inappropriate data features can be a very difficult and time-consuming task. And very importantly, the data that you've used to train the model then has to be prepared and made available for the model to make predictions on a regular, ongoing basis. And that process may need to be created. And then last, a shockingly small number of companies, according to the research, actively monitor their AI and machine learning assets in production, which is a very significant risk. Companies need to monitor their models for data drift, which is the term that describes when data begins to look very different from the data that the model was trained on, or for a decay in the accuracy of the model. The second major thing, and I've seen more models fail for this reason than any other reason, is poor data change management. And what can happen is something changes upstream. There's either new data or a change in the usage of the data that flows down, and the model then starts to see data that it's never seen before, and you can get some very wildly unpredictable results. So it's really critical that once models are deployed, they are managed very, very carefully and actively.
Typically, I see lots of different use cases in banking, but there are use cases and good use cases. And right now we are looking for the benefit, the revenue, the growth, some issues. Can you talk about a little bit about the best use case that you are seeing apply right now?
Yes, absolutely. Probably the single greatest use of AI that we're seeing is in credit. And of course, this is where a lot of the statistical analysis techniques began, many, many years ago, looking at probability of default and loss given default. AI can make these models better by learning from your experience and training themselves to predict default and to predict loss severity. But I've also seen them used to predict collateral values, particularly in home loans, to predict credit line utilization, to help determine the best collection strategy, to predict where risk is rising before it actually shows up in the delinquency numbers, to do loss forecasting, to look at prepayment risk, and interestingly, to look at the risk-adjusted return of a particular loan. The second big area that we see a lot of companies using AI in is financial crime. And this works particularly well because of a couple reasons. Number one, the data is generally available and it's pretty good. Companies know where they have had fraud losses and can typically relate those losses to transactional patterns. The second area of financial crime we see a lot of work in is anti-money laundering. In most cases, banks have a investigational unit and a case management system where they capture all of the data related to the suspicious activity, and they know what their findings are. They know whether those activity patterns were found to be suspicious or whether they were found to be completely innocuous. In many cases, these financial crime detection mechanisms are not very efficient and not very effective. And with AI and machine learning, you can use all of that data that you have to build very highly precise predictive models for detecting and preventing fraud and for alerting you to suspicious activity patterns which may be money laundering. The third thing that we see a lot of work is improving the client experience. Clients increasingly expect you to know who they are and expect you to be there with the right thing when they need it and not to bother them with irrelevant offers. And when they need help, they expect you to get them to the right people very quickly without having to go through an arduous process to find the answer they need or the help that they need for a particular problem or transaction. With AI, you can analyze clients' needs and predict exactly what their situation is and what they may need from you, whether that be an operational problem or whether that be a new product or service that you can fulfill. You can also predict client preferences in terms of how they best want to interact with you or what their pricing preferences are. So, there's a lot of work I've seen going into improving the client experience. And I think banks that put the effort into using AI and machine learning and all of their data in this area can significantly differentiate themselves competitively in the eyes of their clients.
If you have the silver bullet to apply, because what we will see, it really depends of the maturity of the organization, but each company have his history, his fundamentals. But if you have a silver bullet, what can you share with us to help to make the big difference between the winners and the losers in the future?
I love that question. So the answer may surprise you. I've heard many people say that the winners will be the ones with the best technology, or the winners will be the ones with the best and smartest data scientists, or the winners will be the ones with the most sophisticated data architecture, or the ones that have the most data to learn from. I'm going to tell you that those are all incorrect. I think the winners are going to be the ones that best apply AI and machine learning to their business and think very hard about how to leverage the new technologies, how to leverage their data in ways that directly boost their business performance in top line growth, in efficiency, in client experience, or in improved risk management. I see a lot of work being done on AI and machine learning that is perhaps it's interesting, but it's not something that will have a direct and immediate impact on the performance of the business. I think the companies that will differentiate themselves are the ones that use the technology in ways that have the most immediate value, rather than spending enormous amounts of money investing in people and tools and infrastructure, and then potentially being disappointed that they're not seeing the value that they had hoped for. The other really significant differentiator, I think, will be the companies that organize themselves to become AI enabled. And what I mean there is, and I'm not going to go through this in detail, but the point here is that there are many constituencies involved. There are the data scientists themselves. There is the data office, where you typically find the people, the data engineers, the people who operate the data platforms. And then there's traditional IT, the people who run your technical infrastructure and your applications. And you have to get these people working together effectively so that you can move models quickly, safely, and efficiently from development through validation and into production readiness and deployment and then monitoring. And the companies that set up their organizations and their procedures to make this efficient, to make this safe, to make this fast and easy, are the ones that are going to get more AI built and deployed than their competitors. And this is not that difficult to do, but it does require some thought. The other major factor I would say is that companies have to get the governance right. Everybody knows that AI can be used in ways that may not be appropriate, or give you answers that may be misleading or biased, or may have flaws in particular areas. So you have to make sure that you're putting the right amount of governance around the development and testing and deployment of AI. But the biggest mistake I've seen companies make is that they either apply a one-size-fits-all model to governance, or they put insufficient oversight around the models. And if you put too much governance around the process, you'll smother innovation, and many good ideas will never make it into production. But if you make the opposite mistake and have too little governance and oversight, you may be introducing operational, reputational, and regulatory risks that could come back and hurt you. So I think the governance needs to be risk-based. I think you need to consider, for example, what the purpose of the model is. Who's going to be using it? How are they going to be using it? What predictions are going to be made, and what decisions will be made as a result of those predictions? What's the downside risk of those predictions being wrong? In some cases, it's a disastrous consequence, but in some cases, it's really not very serious. You're sort of just back where you started. You need to look at the audience. Who is going to see the predictions from this model, or the results of this set of analytics? If it's a regulator, if it's the board of directors, if it's clients themselves, then you have to have much more validation and testing. Whereas if it's something that's going to be used purely internally just for one department, then maybe much less testing is required. And then the last question I think that's important is operational importance or criticality. How important is this model to your ongoing operations? If the model fails, what happens? Does your operations come to a stop, or can you continue on without the model? And I think these are the questions to ask, and depending on the answers, a different level of governance may be appropriate, a different level of controls, oversight, documentation, testing. I think the worst thing you can do is try to put all the same governance and requirements around every model, regardless of its the answers to these questions.
Where did the companies have to start? I know that most of them already started, okay? Maybe not in the best way, but the train already left the station. But in a ideal scenario, what will be the steps for the companies to do?
I would say the most important thing is training. And it has to start, in my opinion, with the top executives. And I don't mean by this that they need to learn how machine learning works, or what all the different models are, or the statistical techniques or the math behind them. That they don't need to know that. But what they do need to know is what AI and machine learning can do, and how to spot a really good use of AI and machine learning in their company. And I have a few sort of rules or questions that I think may help with that in the next slide in a second. The other thing I think companies should be doing is identifying the most promising areas where AI may be valuable to their business. And I don't mean 50 or 100, I mean just a handful, 3 to 5. What are the most promising areas where AI could be valuable? And then start a pilot. It doesn't have to be a big, expensive endeavor. It can be, relatively small, relatively cost effective. Just try some things and try to use the data, try to build some models and learn from the results. And I would suggest you look at a few of the emerging technologies. The technology has changed radically just in the last 5 years. What was very, very difficult and very, very expensive 5 or 10 years ago is becoming much, much easier because the technologies are getting so much better. And I would recommend you look at a few of the new ones and evaluate them. Look at Data Robot, look at Data IQ, look at H2O. They all have different strengths, but I think you should evaluate some of the new technologies just so you know what is out there and what is possible. And designate somebody to lead your AI program, or if necessary, hire someone. But you need somebody to take ownership of this. In terms of recognizing a great use of AI, I think there's a few questions that really can help a company quickly determine which are the most promising areas. Number one question is, what is it you want to be able to predict, to know in advance? Can you isolate a very specific event or outcome that it would be valuable for your business to predict, like loan default, like collateral value, like how profitable a client is likely to be, like what a client is likely to need, like what a client's issue likely is when they're contacting you and need help. These are all things that it would be valuable to know in advance, to be able to predict. Second question is, what is the business value of knowing this? Is it quantifiable? And can you measure it after the fact? There's all sorts of very interesting things you can do with AI, but I would suggest that if you can't quantify the business value of being able to predict it, being able to know in advance, then you shouldn't spend time on it. It should have high and quantifiable business value before you begin. The third question you need to ask is, do you have training data? There's all sorts of great ideas, but if you don't have the data to build a model from, then it may be a very significant investment to go and acquire and organize that data before you can build a model. I would suggest you don't start there. You want to start with the high value use cases where you have relevant, good quality training data available to you right now. And I would suggest that there are many of those, regardless of your situation. There are many high-value use cases where you've got really good training data available to you right now. The fourth question you need to ask is, how would you insert this predictive capability into your business, your operating model, your business process? In some cases, that is very clear and it's relatively easy. In some cases, that may require pretty significant re-engineering of your business process. I wouldn't start with the use cases that require massive re-engineering. I would start with the ones that your existing business process can use virtually as is. And the last thing I would ask is, is there somebody who is willing to champion the development and testing and implementation of this particular use of AI? I have seen many great uses of AI fail because they were thrust upon an unenthusiastic business executive. Before you try to take this on, make sure that whoever it be, the functional head, the line of business head, is enthusiastic about using the AI and machine learning capability in their business, and is prepared to take on the change management required and to champion the implementation of the model, the training, the communication, making sure that there's adoption. These are things that require sponsorship, and there needs to be a champion who is willing to take that on. And if you don't have a strong champion, I would suggest you deprioritize those use cases.
So we can also use that questions to create a roadmap.
Yes.
Okay. Great. HP, concerning the actual scenario of COVID-19, do you have any pandemic-related recommendations for us?
Yes, I do. So number one, model risk. Model risk is as high now as it's been in the last decade, since the financial crisis of 2009, 2010. Many models in production may have simply stopped working because of data drift, because the data since the middle of March may look very different from data that you've seen ever before. So it is really, really, really important that you are actively looking at all of your models in production and identifying those models that may have degraded in their accuracy or may be producing erroneous results. So it's critical that you have an effective process in place to identify those cases where model risk is high. The second thing is, there are obviously areas, back to that chart you showed at the beginning, showing the industries that are likely to have the most stress and recover the fastest. The financial stress in your portfolio is not going to be evenly distributed. There are going to be some areas that continue to perform well, but there's going to be some where the financial stress is high and increasing. What I would suggest is you want to use the predictive modeling techniques to identify where that risk is rising before it shows up in delinquency numbers, before it shows up in defaults. And I think there are good ways to do that. I just finished a project for a client looking at credit card, auto loans, and home loans, and looking at indicators that have historically preceded delinquency. Things like increased utilization, slower payments, changing behavior. These are things that you can train a model on and you can use to identify areas of increasing financial stress, and then segment your portfolio so you know where you need to focus the most attention to mitigate those potential losses. And then the third thing I would say is there are many ways to use predictive analytics to optimize outcomes and to proactively engage clients. If you know which clients are experiencing financial stress, and you know where your risk is rising and your future delinquencies and defaults are coming from, then you can use these models to not only proactively identify and engage clients to try to help them out, but you can also decide what your best strategy is to get the best possible outcome for the client and for the bank. And a lot of data can be used in terms of, for example, in auto lending, previous repossessions, and determine what your best strategy is. It to extend payments? Is it to aggressively collect? Is it to go to repossession as quickly as possible? You can use a lot of the data that you have historically to determine what the best strategy is to get the best outcome for the bank.
I think we have now time for some questions. Data is like a cheese. Sometimes it's a mess, sometimes have lots of holes. But my question to you, the question is, if your data is a mess, what can we do?
Yeah, it's a good question. I have never seen a bank or a fintech where there wasn't reasonably good data for a number of use cases. And what I would suggest is identify the most promising uses of AI and machine learning using some of those questions that I suggested earlier. Determine what would be valuable to your business, and then look at it based on a matrix of complexity versus business value. And in some cases, you're going to find very, very, very high complexity, where a significant investment in platform, data acquisition, data engineering will be required before you can build and use a predictive model. But in some cases, I guarantee it, you're going to find that the data is available. You've got transactional data, you've got client data, you've got data from an operational system or a case management system. And if you build a grid of quadrants where you put these ideas and determine which ones have the best value with the lowest complexity, and start there, I think you can make some pretty fast progress. Now, there are also going to be some things that you see that have very high business value, but are more complex, where the data is of questionable quality. It may have, may not be complete, may have holes. Maybe it's not that easy to get and to assemble. Those are going to require some investment. But if the business value is very, very, very high, I would suggest you select no more than a couple of those, 2, at maybe 3 at the most, where you put some investment in to cleansing that data, acquiring the data, synthesizing the data, putting some controls around it. If you have to do some remediation to fill in some of those gaps, there are tools that will do exploratory data analysis and tell you where those gaps are. The worst thing you can do is to try to waste a lot of time on data where the business value is not high. So what I would suggest is take your ideas, array them on this grid where the business value is high and the complexity is low, get started immediately. And I guarantee you there will be 5 or 6 great ideas in that quadrant where the complexity is relatively low and the value is high. There's going to be several where the value is high and the complexity is high, and those you have to be more careful with. Invest in them selectively. And if you get into it and it looks very, very complex and very, very costly, be quick to change horses and go to another one. But I wouldn't give up on them. I would for the ones that have very high business value and are potentially strategically and competitively valuable, pick a few of those to put some investment in and try to make progress.
Okay. What is your opinion about auto machine learning?
Automated machine learning is a relatively new technology which takes a lot of the business process of data preparation, selecting the appropriate models, building the appropriate models, testing and validating them, comparing them, finding the best model, and then ultimately deploying those models into your production environment. And the best automated machine learning tools do all of that, from data acquisition and preparation all the way through to ML ops. In other words, deployment and monitoring of models in production. The problem with automated machine learning, or auto ML, is a lot of vendors claim to have auto ML, but they don't. So you have to really look carefully at what they really have versus what they claim to have. Not everybody's auto ML is created equal. In many cases, and I won't mention names, but in many cases when somebody says they have auto ML, what they mean is that you can take your data and train some models. You select the models and you train them. That's not really auto ML in my opinion. True auto ML is a system that's able to take your data, automatically select the most promising models, automatically build them, and then tell you which model gives you the best results. That, in my opinion, is truly automated machine learning. So I think that auto ML is a very, very powerful technology, but I would be careful, just because someone claims to have auto ML, you have to look very carefully, because not all auto ML is created equal.
Okay.
And I have done some research on all the technology providers out there, and if anybody's interested in having a more detailed conversation about that, I'm happy to do it.
Okay. Where should we focus first in this journey?
Yeah, what I would suggest is you have to train people on what AI and machine learning is, number one. Number two, I think that a series of workshops to identify promising ideas is a very, very good thing to do early on. Having a discussion about which of those ideas are most promising or have potentially most value to the business things that may give you a competitive differentiator or improve business performance. Identifying those and deciding, how difficult are they going to be to do. Those will immediately bring you to some of the better applications of AI machine learning. But I think my short answer is there are dozens of great use cases in credit. There are dozens of great use cases in financial crime, and there are fantastic use cases in marketing and improving the client experience. So, not knowing anything about a particular company, I would say those are the areas that you probably will find some very, very valuable application of these techniques first. But I certainly wouldn't say those are the only areas, but I think those are three very, very promising areas.
We have also a question concerning, for example, these new times of COVID-19. So in a more and more changing and unpredictable world, for example, with COVID, what can we do so that AI-based predictions can deal with that?
Yeah, fantastic question. So there's really only two options, right? Number one, you can build a model using data that reflects the current reality, and that limits you to 12 to 15 weeks of data. And that's what data scientists refer to as a cold start problem, when you don't have necessarily enough data to build an accurate model. Now, there are ways to get around that. You can synthesize additional data. There are ways to use limited data to build an initial model and then continuously improve that model as more data becomes available, retraining it continuously every day, for example. But I think an even better answer is to look for informative features or data that is predictive that works well regardless of the current situation or not. In other words, that are predictive regardless of the cause of financial stress. And there are a few examples. So if you were looking for an early warning for, let's say, a small business credit becoming a problem, going into delinquency and default, in many cases, you know what those small business deposit accounts look like. You know where the cash inflows are coming from, and how frequent and what size they are. You know what the cash outflows are, where they're going to, what they consist of, and you probably have that data going back over many years. And one thing that I've seen tried that works really well is you can use the cash flow within the deposit account to predict financial stress. And that will work regardless of, what the reason for financial stress is, right? Whether it's a
new normal.
a recession, or whether it's a pandemic, or whether it's just one industry that is suffering, from stress. There are features, there are data features that can be built that are predictive and can be trained on data prior to the pandemic, but then applied using data after the pandemic that I think are accurate and will be useful. But the trick, of course, is finding those features.
You show in one slide MLOps. Can you please explain the concept and why you think is important?
Yes. Sorry, I should have explained that better. So there are a number of tools out there that allow an IT organization to monitor application health, to make sure that systems are functioning normally, that they're running well, that response time, for example, is good, that everything is producing expected results, and nothing looks like it is becoming unstable or close to failure. And those tools have been around for a long time. Unfortunately, those tools are useless for the monitoring of predictive models. For those, you need a whole new set of monitoring techniques. And those collectively are now known as ML ops. And what ML ops allows you to do is to watch for situations that may indicate that your models are in danger of failure. Looking for data drift, looking for data that is different from the data the model was trained on, looking for degrading accuracy in predictions versus actual outcomes, looking for particular segments of the population that may not be as accurate as other segments in the population. It may require a specialized model to understand behavior within that particular segment. These are all things that data scientists would normally do, but as more and more AI and machine learning is built and deployed, this really needs to become a discipline that the IT group learns and takes over and assumes responsibility for, to monitor all of these predictive models, all of the AI and the machine learning that is becoming tightly integrated into production applications. And as I said, the existing tools are not really helpful. So it requires learning some new things and putting some new tools in place. But that discipline of ML ops, I think, is going to be increasingly critical, and something that regulatory authorities are going to increasingly expect to see when they look at how you're managing AI and machine learning capabilities in production.